Good morning. We're going to start with a top-line quote from President Trump that occurred yesterday during an interview. Then he gave a slew of interviews during the day. But one of the things that he said yesterday is going to drive our Breakfast Club presentation for today. And the upshot of this is, although Trump tends to be cheerleady, he certainly tends toward the rah-rah end of things economically. There was something in this quote that if you look past everything that's taking place right now, there's something that's going to has the potential to significantly impact not just the economy, but also artificial intelligence. And the converse to this is why certain groups of AI stocks yesterday took it on the chin harder than the overall market. Now, that quote from yesterday was related to oil prices. And President Trump said, we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than ever or than even before. And it's that last phrase that caught my attention and sent me into a little bit of research mode. And I'll share with you why that's important, how you can attack it, and what it means for us. And despite yesterday's really red open, stocks fought back. And a reminder, as Warren Buffett himself used to tell people, when everyone else is afraid, that's the time to be greedy. When everyone else is greedy, that's the time to be afraid. This is Breakfast Club. I'm John Hutchinson. Happy Wednesday, March 4th. Let's get rolling. Looking deeper into what happened yesterday. These are the results from yesterday. Futures are up today. There's a solid rebound taking place. On the back of that rebound, strong earnings from Target, from Ross Store, from Best Buy. Abercrombie and Finch today reported record sales. From an economic perspective, very solid retail reporting that suggests that the consumer is holding up. And consumer is everything when it comes to our economy right now. As well, at 8:15 this morning, the ADP weekly employment index came out. That came out above expectations. That could have positive impact heading into Friday's jobs report. We'll see how that transpires. We're now in ongoing, obviously, the day 5 of the conflict in Iran. Monday through yesterday. All of the focus was on the issues surrounding the Strait of Hormuz, which we talked about during yesterday's Breakfast Club. But I want to bring that point back on a different level as it relates to artificial intelligence stocks, because there are some very important pieces to that can have an impact on the stocks that we're trading, stocks we may trade. Trump announced late yesterday via tweet that the Navy would begin escorting tankers. There's a caveat to that, and I'll come back to that here in just a second. Most importantly, as it relates to artificial intelligence, to the semiconductor industry, Broadcom reports earnings. We'll take a look at those earnings expectations and see what Wall Street's looking for. And then tomorrow, when we get back together, we will look at the actual earnings from Broadcom. But right now, the connection between energy and AI, and this is why the issue around the Strait of Hormuz was important, as well as some of the missile strikes that Iran has effected in retaliation. One of those strikes hit Qatar Energy, which is an LNG producer, a liquid natural gas producer in the Middle East, which supplies Europe with a significant portion of their liquid natural gas. Natural gas prices jumped like 40% yesterday in Europe. Here, not as much, because the U.S. is a producer of liquid natural gas, not as great an importer of liquid natural gas, but natural gas was still up over 3% yesterday. But the connection here, as it relates to artificial intelligence, has to do with data centers. And as you probably heard either through our past meetings or through the news, the energy requirements for data centers is immense. And most of that is right now being supplied by natural gas. So any disruption to natural gas, whether that is produced here in the US or imported from foreign sources, any disruption to the supply or the price has a significant impact on data centers. Data center operations that are currently in working underway, and planned data centers that are expected to be built in in the future. And the reason that that has an effect is, one, at current prices, if the price jumps for any of these energy sources, it impacts margins for the hyperscalers, right? The Amazons, the Metas, the Googles, et cetera. The companies that are building out the data centers suddenly have to pay more to supply the energy to them. This is one reason why alternative energy sources are being sought rapidly by the companies that are building out future data centers. That includes solar, that includes potentially nuclear, which has already taken place. Constellation Energy Group, CEG, is a provider for Microsoft Data Center, as well as self-sufficient power sources for data centers. But as it stands right now, any negative impact to their margins, to the cost of operation, runs the risk of slowing future growth of data centers and or reducing the amount of money that is already planned to be spent this year, which is in excess of $700 billion right now. And that negative impact then affects the supply chain. And the supply chain for us in AI2 is where we have had our primary focus: semiconductors, chips, memory, storage, optical connectivity, right? So if you were looking at your portfolio yesterday, scratching your head saying, why are we getting punched in the face harder than the rest of the stock market? This is the reason why. And it also is the one area that can reverse faster if this situation with the Strait of Hormuz is resolved. And as I said a moment ago, in a tweet last night, President Trump stating that the Navy would begin providing essentially escort to ships in through the Strait of Hormuz, and essentially, I'm going to paraphrase this because this is not technically perfect, but essentially guaranteeing financial protection. Where I mentioned yesterday that insurance companies had essentially told the shipping companies, this is an act. These are acts of war. You're not covered, and we're not going to pay you. Trump taking essentially the opposite position, saying we'll take care of everybody. So we'll get you through, and if something happens, we'll take care of it. The problem in the very, very short term is the Navy doesn't have the ships. They don't have the ships to provide those escort services. That's likely a short-term problem. It's a capacity constraint because obviously they're a little busy right now. But more importantly, if the Navy is able to move those ships into that are necessary into the Persian Gulf area, then that should result in an unwinding of the concerns around disruption to the energy markets, whether it's liquid natural gas, whether it's petroleum. It's basically this is a reversal of yesterday's worry or wall of worry that that brought Wall Street out in the negative at the outset of yesterday's trading action. So, in the current context of what's taking place, there are essentially three scenarios. The base case is largely being expected to be somewhere on the order of an additional 1 to 2 weeks from right now, where either the ability for Iran to impact things in the Strait is eliminated, and or the insurance companies, take a step back from the brink there. There are a number of analysts out there who are essentially saying this is not as serious of a concern or problem as was originally anticipated ahead of Tuesday's market action. The more likely scenario is in the middle here, something taking effect over the next couple to 6 weeks. Again, where the U.S. Navy starts escorting ships through the Strait of Hormuz to provide protection. This is not unprecedented. In 1987, 1988, there were escorts provided during what was called the tanker wars. And there's no disruption to the overall supply of oil, even though oil prices are up. And we talked yesterday about oil having to stay basically below $100 a barrel. If it breaks $100 a barrel, that's going to be a much larger economic problem. But right now, as far as I know, it hasn't. Even on the future side, crude oil is actually pulled back from yesterday's high by a couple of dollars. Not a huge pullback, but enough. So West Texas is around $74, Brent crude around 81. Those are off from yesterday's highs. So as those pressures decrease, you should start to see the stock market return to a little bit of normalcy. Remember that, as we talked about back on Monday, when Wall Street looks at an event like this, they take the absolute worst case scenario, and that's what they price into the stock market. And then they try to make it better from there. And that is essentially what has happened over the last couple of days. And even the worst case scenario is essentially something that is an event that is extended, where the Navy can't supply the ships, or the Navy can't provide the protection, or ships can't get through the straits. That's where Wall Street started. I think you start from there, you work backward toward the moderate to base cases here. That's the direction that we are heading. And that is also why I think as we go through the next couple of days, we will begin to see improvements in many of the stocks that we're holding in the AI2 portfolio. Like I said, we took a hard hit yesterday. It was very similar to the hit we took late last week on overall inflation concerns. So essentially, we are going up, we're going down, we're going up, we're going down, but we're doing it on a daily basis, which is frustrating to me. I'm sure it's frustrating to anyone following the portfolio, but this will abate. This will fix itself. It just takes patience and a little bit of time. But outside of that, one of the things that I wanted to share with folks today was an outcome that nobody is talking about. And this goes back to the quote that Donald Trump was made yesterday during that interview, which I led with here, that prices may come down lower than even before. And if it is possible that this is a little bit of contrarian thinking, but it is possible that oil prices actually come down further or lower than where they were prior to the conflict itself. And the reason for that is the potential for, call it this, absolute stability in the Middle East. And if that happens, then it is entirely possible that oil could be at levels we haven't seen in 15 to 20 years. The market, as I said, is pricing in the worst case. The best case is this is something that isn't getting enough talk about. There are a couple of people saying something along the lines of this, but there's a note from Barclays that this could lead to more stability in the region. That is a reduction in the terrorist organization threats, that the Houthis, the Hezbollah, Hamas, etc., no longer being backed and provided by Iran. Suddenly you have greater stability throughout the entire Persian Gulf region. And if that's the case, and if any of the energy elements, oil, gas, petroleum, base petroleum, liquid natural gas, etc., that has the potential to create much less expensive energy solutions for the artificial intelligence industry in the data center development and production and provision of services. So that creates a more stable energy environment. And that completely flips the margin script because now it's spending, instead of potentially spending more for energy, you're looking at potentially spending less for energy. So this is a we need to watch this development. It's not a prediction. It's not a projection. It's a possible outcome, but it has a positive bent to it that really isn't being looked at because everybody's focused on the now, I'm sure. But it's clear that Iran is not necessarily capable of closing the Strait in full, and there are solutions already coming to fix that problem. And I think that's what the market is pricing in as it bounces back a little bit today. We'll see how long this conflict actually lasts. The shorter this conflict is, the faster the market returns to normalcy. Frankly, the faster we start focusing on things that really matter in terms of economics, economic data, et cetera. On the back of my discussion yesterday related to inflationary pressures, we do have the ISM services at 10 a.m. today. And in that will be the prices paid function, which I will be looking to see if it has a similar rise that we saw from the ISM manufacturing report from Monday. And if that's the case, that would be a better explanation for why last Friday's PPI producer price index jumped more than was expected. And anecdotally, at some point, those prices have to roll down to consumers. Companies can't keep taking margin hits. Margin is right now, reduced margins, profit margins are one of the number one reasons that stocks that are beating earnings are actually ending up lower post earnings. It's not because they beat earnings, it's unrealistic expectations and the prospect for lower margins. I'll come back and talk about that when I talk about Avgo here in just a second. But one of the things to keep in mind, as I shared the old quote from Warren Buffett, one of the steps that you can take to protect yourself is a process called averaging down, or for those of you in the option selling market, reducing your cost basis. It has positives and it has negatives. The key to the positives is this. If you're focused on companies which have strong fundamentals, they have rising sales, rising earnings, future growth prospects, then the benefit to averaging down is you decrease the cost of your shares, the shares that you own. And if you happen to be in the red, and we are in the red on some stocks in the AI2 portfolio, you reduce the amount of time it takes for you to get back to break even. And once you're back to break even, then you can make a better or more informed decision about holding or not holding. But the biggest challenge is if your stock goes down 10%, it takes more than 10% for the stock to return to break even. So if you have a path where you can decrease that cost basis even a little bit, you shorten the requirement on the upside for the stock to gain to get back to break even. And I generally focus on one of two paths, and that is a 1-for-2 or a 1-for-1 approach. 1-for-2 is basically buy half as many shares as you already own. And a 1-for-1 is to buy equal shares of what you own. So for example, if you own 100 shares of a stock, on a 1-for-2, you would buy an additional 50 shares. That'll reduce your cost basis by about 30%. And if you have 100 shares and you do a 1-for-1, you would buy an additional 100%, and that would drop your cost basis by 50%. And pennies and nickels notwithstanding. But essentially what that does is it speeds your time back to break even. And that would be the objective. Now, I mentioned that there are risks. In an instance where we sit right now, which is backdrop of the Iran conflict, we have the rising inflation, the Fed uncertainty as it relates to interest rate cuts. The risk is that you're not at the bottom. So the question isn't what to do, it's when to do it. And that can be the difficult part. If you can accept the risk, then the when can be less important. You can also continue to average down for stocks that you know or at least believe are going to recover. In other words, stock's not going to go to zero, where that's not a likelihood. An Apple, for example, isn't going to go to zero. Um, but the risk is that you take the leap and the leap into the market on this approach. You average down, whether it's 1 for 1 or 1 for 2, doesn't matter. And then the stock drops another 5 or 10% below where you averaged down the first time. All right, that's the risk, is that you're not necessarily at the bottom. The the one thing that I personally want to avoid is trying to time the market. So if am going to elect this strategy, and I'm looking at it right now for the AI2 portfolio, I'm going to wait until I have a series of up days. That at least gives me the technical validity that stocks are rising again. I can't predict the future. I can't do anything about some other event negatively impacting the market. So I can only make the best decision in that particular moment of time, or at that specific moment in time. So I would look for at least a 2 or 3 day upstretch in the individual stocks where I may be considering averaging down. And here's an example from the AI2 portfolio. Please note, these are not recommendations. These are not actions that are actually being taken. These are examples for illustration only. These prices are from yesterday on the now column in the middle, so they're already dated. This is simply to give you an example of the recovery process. And I'm largely going to focus on the do nothing in the middle, which is right here. So you can see we were, the loss in the do nothing. So we were sitting on some of these stocks with losses from 8 to 14%, which would require 8 to 17% gains in order to get back to break even. But if you take this process or use this process of averaging down, then I can reduce those break evens to a range of 6 to 11%. If on a 1 for 2, that's if I buy half, and if I buy this equal number of shares here, I can reduce my percentage to break even all the way down to 4.5 to 8.5%. Right? It is these numbers I'm circling here. It is this process that you're after. This is cutting in half the gain needed to get back to break even or even close to profitable. That is a substantial reduction, and it can also often happen in just a couple of trading days. So the do nothing is you have to sit and wait, and the stock has to gain 12 to 16%. That can absolutely happen in a couple of days if the market is that generous. But more than likely, it would take an extended period of time. So this is right over on the far side, this is a time function as well as a cost and return function. I'm just going to put return as a percent there, right? These are the things that you're balancing as an investor, as a trader. Anything that reduces my time to profitability is a good thing if it can be balanced against the cost and the potential for a return. So if I still have strong fundamental beliefs, and I do, on the example stocks that I've listed here, from Silicon Motion, AMD, On Semiconductor, ASC Technologies, MaxLinear, Lam Research, I still believe that these companies are going to be higher in the future than they are today, even though we're playing from a pretty far behind. But if I can shorten that time and get back to break even, then I can make a different decision. And if I'm looking at it may take 30, 60, 90 days to be profitable, then I can at least decide at break even whether I want to take my capital back and do something else with it, or stick with the stock. And the other issue is oftentimes you can see, I'll just do a quick little thing. You see a stock goes down and then it comes back up almost to break even and then it goes back down again. That's one of the risk elements in the averaging down approach. So I'm not going to take losses at 8 to 17% against the backdrop of a geopolitical event, because it is neither fundamentally driven nor is it economically driven. It may have impacts on fundamentals, it may have impacts on the economy, but those are short term and they can be overcome. So I am not going to take those kinds of losses. That's a no. I will look at these options and work. I may use one or both of those and then make a different decision 15, 30, 45 days from now about holding a stock. Those are the types of decisions that you can make. There is a process now that you can use to work with. And I think that is gets us to the Avgo earnings. A couple quick notes on Avgo, and we'll get you off to your trading day. The one issue that I've been seeing consistently is I've referenced this multiple times, unrealistic expectations by Wall Street as it relates to semiconductors, chips, memory storage. MongoDB yesterday, down 30% post earnings after reporting earnings, because Mongo, again, things not to say on a conference call. Mongo's executives said that their Atlas platform, which is their defense against disruption from AI, would slow in growth from 27% to 23%. Stock down 30%. 23% growth in a product line is strong. 27% is certainly stronger. Does a 4% decrease in that growth rate justify a $70 sell-off in the stock? I don't have the answer on that, but my instinct says no, that it's another overreaction because expectations were unrealistic to begin with. Avgo has some similar issues. This is a company that tends to do well with their earnings, meeting or beating expectations. They don't meet or beat by substantial amounts, but they do have some really wacky responses. When I look at the numbers, and I'll show you this tomorrow after the actual report, tonight after the market close, and we see how the market truly responds. But this is one of those companies that can go up when they miss and go down when they beat. One of the most frustrating earnings experiences in the markets. However, right now, expected $19 billion in revenue, $2.02 to $2.03 EPS. So the major questions, have they maintained or expanded the margins from their acquisition of VMware? VMware, for historical purposes, was the stock I originally selected in 2023 in my portfolio, in my growth portfolio, which then was acquired by Avgo. So in that portfolio that I continue to track, I fell into Broadcom. I didn't own Broadcom originally, but that company VMware provided a high margin, high growth product line to Broadcom. So is that continuing to grow? Are they expanding or are they reducing their backlog? How does this relates back to the NVIDIA problem from last week, where NVIDIA suddenly had excess supply of their one of their chips, not the Blackwell chip. I think was the Grace chip. But what has happened for supply and demand for Broadcom? So these will be the things we will be watching. It is one of our picks. It has been in the red. Actually, it's on the chart. Avgo right now has all of its moving averages converging to within about a $15 difference. So I think pre-market today was sitting around $3.19. The 50-day moving average is $319. And the 50-day moving average was sitting at $300 and $34. So a $15 difference between current price and the 50 moving average. Didn't matter if it was SMA or EMA. There was about a difference of $1 there. The 20, the 10, and the 200 are all be in between the current stock price and the 50 EMA. So that's moving average convergence. So that's an inflection point. If Avgo beats today, they may be the one company that finally breaks out and goes up, or it could be the opposite. Given markets' reaction these days, it's hard to tell. So with that, we will be back tomorrow with looking again at what's happening on the sell side. Where are the opportunities during this conflict? We talked about the outcome that isn't really getting attention yet, but I think it will as things settle down and achieve resolution. I think that's where people will start focusing on this idea of oil negative, growth positive. Averaging down is a tool. Again, it involves both opportunity and risk. You need to weigh both. So we'll watch Avgo tonight. We'll be back tomorrow morning at 9 a.m. And that is Breakfast Club for today. Take a quick second. I've got a question here from Mike. Top performers are semiconductor heavy. In the past 2 days, obvious rotation into software. Yeah, there's been a little bit. I noticed that, right? You're talking ServiceNow, CRM. There was another one that I saw. All had surprises on down days. They were up. It's a good observation, but I keep in mind that you're looking at rotations from bottoms. In other words, are they rotations or are they value hunters? If we take a look, I've got a couple of extra minutes, so we'll take a look at CRM. Let me switch the slide and I'll show you what I'm talking about. And so here's CRM. This is what I mean, right? That's a bounce off of a bottom. So, and that's number one. This period right here, right around their earnings. And oh, hang on a second. I got to stop share for a second. Let me get to the right charts. No. There we go. All right, let's try again. I wanted to zoom in here. It's a good question, Mike. And this is why you can see right around the earnings period, a clear bounce off the 180 up to 200. So a little over a 10% move. But since that time, settling back, and still range bound here in this $20 range. And longer term, right? That's CRM's longer term, dating back to the beginning of last year. That's probably a little too far. This is pretty decent right here, right? Had a solid range here in 280 to 240. That broke down, and so the question isn't, is this a rotation? The question is, are some companies looking for value? That a stock may be coming off of a bottom. In other words, I don't think right now that the evidence is clear that it's a rotation. You look at ServiceNow, you see a similar pattern. And although this is not post earnings for ServiceNow, they actually fell because of their earnings. But this is coming off of a bottom. There's another company that I had been thinking of. But let's do a comparison. Here's SanDisk, range bound, right? Since we exited on this day, the one day, range bound, right? It's not breaking 700, but if you can pick up shares at 600 or below, right? I certainly do that. RSI has gotten down to a new low. That's okay. What I think you're looking at is just a stall, right? It's kind of like an airplane. just pointed in the wrong direction and it stalls out. Here's Micron, similar pattern. If we look at Western Digital, similar pattern. Seagate Technologies, similar pattern, but a little bit of a deeper sell. Oh, man, that's a buying opportunity right there. Look at that. Heck yeah, give me some of those shares. Right. So what you're seeing isn't necessarily a selling rotation intra AI from semiconductors to SaaS or software. I do think you're looking at more of companies looking, Wall Street traders looking for value opportunities. Let's look at Braze, right? Another one. So is it a trend, or I mean, again, it's back to a line, but it's not back to the main line. These stocks are still trading below their 200s and their 50s. Until they're up above their 50s, I would argue temporarily, and I will take more look at this before next Monday. I would argue temporarily that these are reversions. But that doesn't preclude. I mean, there's a company that has the potential. If it breaks through 20, it might trade back up to 24, 26. That's a potential 20% gain. Certainly has made a strong gain. This is Braze, by the way, BRZE. This is, powers up here. None of this is earnings focused. Nope, they reported earnings way back. Right. So there you go. They missed earnings. Here's an example. Missed earnings, and the stock went up 18%. Can't explain it. And then waterfalled, right? So you look at some of the different companies, and you look at IBM. IBM is really in a wedge right now. You can see this big red bar, and then everything, all of the trading days following that are inside of that red bar. So maybe value recovery, not necessarily rotation, but that doesn't preclude it from being rotation. In part because the sector has been beaten down so heavily. It would take an immense amount of push higher for many of these companies to recover. I'm looking for a couple of other examples. I do want to follow Okta because they report earnings today too, and interesting setup at the bottom, and see how their earnings play out. But here's another company below. It's the green line is the 200-day moving average. So this stock is currently trading $20 below its 200-day moving average. This is the fallout from that Claude Cowork announcement, in that many of the stocks in the sector have been beaten down so badly. Are they at a bottom and simply coming off of a bottom? MongoDB. I mean, there's your. Actually, let's close that. There's your $30 drop. Earnings. No, I don't want a price alert. Earnings. So revenue surprise. Look at this. Their GAAP earnings were estimated to be negative and were positive. Their overall revenue, top line EPS 11%, 1,500%, which is a ridiculous percentage. On the GAAP side, that means all costs accounted for, and they beat on revenue, and the stock went down 30% yesterday. So this is what I mean by what is it that Wall Street does expect. And you can see the bottom on MongoDB, another software SaaS type company, had an update post earnings, but only if you were lucky enough to buy in at 235, all the way back down. I mean, that's a rainbow in essence, right? Started over here, breaks out, double breakout, and then collapses. That might actually be an entry point, but not a pretty chart, right? So now it's below all of its moving averages. So the moving averages, this is what I mean by, are they value hunting? If the moving averages are going to come this way, and then the stock price comes back up this way, reversion to mean, but I don't think you have a legitimate mean for the stock to revert to yet, because it's not not accounting for this gap, barely accounted for this gap before it rolled over. That anyway, yes, I think there's the potential for that rotation, but I think right now what we're really seeing are selective value hunting. Uh, and if it develops over a 30-day period, then I would argue it's both rotation and a trend, maybe a little bit less than that. But as we've seen, many of the stocks rather in the AI sector have been a little bit top heavy. And I mean, look at Lumentum, right? One of our big winners from late last year and even the beginning of this year, starting to get a little bit top heavy at 700. But that is after the stock has doubled since the beginning of the year, basically from 350 to 700 roughly. So, but keep in mind that I did say earlier this week, and even on, I think even on AI2, that although the software sector in the AI2 index is the worst performing sector, I do think that that kind of rotation, that kind of opportunity exists. I just don't know that it's now. I don't feel like it's just yet. I think we need to see 1 to 2 quarters from software companies without earnings disruption before Wall Street truly believes that these companies are not threatened by displacement from artificial intelligence. It may only be 1 quarter, 1 earnings period, or maybe 2. But that's my expectation, is that Wall Street's going to need to see the validation that earnings, revenue, margins, et cetera, have not been impacted. That there is not actually a flight to AI away from software as a service companies before there's a true trend. Now, we'll try to be ahead of that as selectively as we can. CRM, less likely to be impacted long-term. ServiceNow, maybe. There are some other companies that we'll start taking a look at here in the weeks ahead. But the other part of that argument to me is supply chain and semiconductors may be a little volatile right now, but they have the highest EPS potential going forward. And that's the other reason for my focus on those groups in the AI2 index, whereas the software sector is half of the EPS expectation of the supply chain alone. Supply chain forward EPS expectations 33%, software or the AI solutions section, which includes software, is 18%. So a little less than half, but still, that's a stark difference in forward EPS expectations. And it's why I still think supply chain is the right place to be. Yesterday, supply chain was certainly not the place to be. Today, an improvement as the market has opened. Actually, how are we doing on the market open? Good. Well, we picked up almost 1% back. Micron up 2.5%, Sienna up, and Prius is up. I believe they report earnings tomorrow, as a matter of fact. They do, tomorrow before the market opens. So we've had a good open. We'll see how things turn out. So that was a great one. It was a great report on the fiber optics. Thank you. I still like Lumentum. It's a little more difficult, Anastasia, it is a little bit difficult to put that one in on a smaller portfolio with just a couple of shares. But that's what precipitated rebalancing the portfolio so that I can buy more shares of stocks. But yeah, I love Lumentum. I still think that stock has a long way to go. When you look at their forward financials, right? That's quarterly. Let's look, right? But one thing I would caution is they are halfway through this fiscal year. There's their primary growth. This is an outlier. So I would not put a lot of focus on this 2029 earnings. There's only one analyst who has hung their hat, but that analyst is projecting a 70% decline in annual revenue. I would love to see what their numbers are for the previous 2 years, because that's a seriously weird decline. And it looks like they have done the same thing for revenue. Yeah, so you can see one analyst predicting rainbow revenue, a rollover in revenue. So a revenue to fall below 2027 and 2028 levels. Um, I would be cautious about pricing anything out that far, but sometimes I'm at the mercy of what's available, and they didn't even provide gap earnings, which is kind of funny. But even if you're holding for a short period of time and you're looking at a stock that is still, this is a 50% discount from the current fiscal year out 2 years to 2028. That is on a forward PE basis. That is still a stock that has extreme value to you as a longer hold. Um, Also, 9 fewer analysts here. This catches my eye because I like to see the same number of analysts, or plus or minus one or two. When you start seeing plus or minus 10, then enough companies have not provided forward numbers. And so, yeah, it's not that you call this number into question. It's what you don't know is, if you think, we'll go like chemical symbols, bull, bear, right? BU for bull, BE for bear, right? You don't know how many of them are up here for bullish and how many of them are down here for bearish. You can get a general sense. This is one of the things that I do like about FinViz. They've added this new thing in here, but we can see that there's a high target here of $900 a share. So you've got a couple $100 built in there. But the average target right now is a little bit below where the stock is currently trading at 679. It is up. The target is up since February 10th. And somebody has a low target of 345. Good luck with that one. And EPS performance and forecast. That's quarterly. I mean, annual, is that going to change anything? Yeah, not going to change anything. So short interest is low, 15%. So there are shorts out there, but it's not as high as it was. Where is that? Back here in December, and even all the way back here in early year. Man, there's nobody trading this stock for 6 months. Look at that chart. Just on a short basis, but even on the long side, nobody trading that stock until right here. We practically caught what, 70% of that move with 3 different trades. I would like to find more of these. So anyway, longer breakfast club for everybody. Hope nobody's bacon is burning. But you're right, Anna. Good pickup at 598. So you must have been back in here one of these 3 days. Good for you. I mean, keep holding. Don't be surprised if you see a little bit of a challenge here back to the 20 EMA and in the 620 to 635-ish range. But I think that the financials, the forward expectations for Lumentum still justify holding that stock at least into their next earnings period, which is Feb, so March, April, beginning of May. So you've got at least a couple of months on that one. Kramer sell call. Jim Cramer telling everyone to sell. So shouldn't everybody urge selling due to the stock's 6-month run up? Well, optics peers like Credo, who just got destroyed on their earnings report, and AAIO, no, you're wrong, Jim. You need to get off of television. Anyway, yeah, because the stock ran up. That's the reason to sell it. Well, okay, you could have made that argument here when the stock was 200 and ran to 400, right? Stock's up 100% right there in 60 days. Sell, bang on some things that make noise. Well, but then you missed all of this, where the stock has run up, in essence, 3x And so, yeah, Wall Street's pricing in those earnings, which is that's what we do. That's why we're ahead of the street sometimes. Wall Street is pricing this year in, this 2028 year in. Um, and not pricing in 2029, obviously, but they're pricing in growth here between 2027 and 2028. And that's why the stock is inexpensive. This says 48. That's fine. But it's a huge reduction in the price to earnings ratio. So at any rate, there you go. Back on the long candle, bluish candle. You see that one, this one here. So that would have been maybe whatever. I can't read the date. Feb 17. Good call. Nice day. Nice day from 528 to 600. Next time, get the 528, not the 598. Save yourself $70. As if we're ever going to be able to get the bottom. But that's good. There was a solid bottom in Lumentum right there, a little bit of a rising wedge with the price action moving higher on the days, but relatively flat here across the bottom of this group of days here, and then a breakout. So anyway, all right, that is Breakfast Club. Let me stop my recording here. And actually, let me find my recording to stop. There it is.